Welcome back to the Deep Dive. Our mission today is to give you the shortcut to understanding the 2026 global economic outlook, and we're using the highly influential work of Mohamed El-Erian.
That's right. We synthesized a bunch of his latest analysis, and the core message is, well, it's pretty urgent. He uses this word, recalibration.
A massive recalibration.
Exactly. And it's all driven by this one big prediction. He basically argues that 2026 is the year that the big bullish 2025 AI story, it fails.
Fails to do what?
Fails to keep masking these much deeper structural problems and global shifts that have been building up under the surface.
Okay, so let's unpack that. I mean, for years, we've all been focused on the traditional stuff, right?
Sure.
Inflation, interest rates, job numbers. But El-Erian's saying those things are now becoming secondary.
They are. The things really driving global markets now. It's national security concerns, it's pure geopolitics and, messy domestic politics.
So it's a shift from just economics to geoeconomics.
That's the perfect way to put it. So if you're an investor, a central banker, anyone in government, the old rules just don't apply anymore. You have to adapt. It's not about optimizing anymore. It's about navigating turbulence.
And to really get where we're going, we have to understand 2025. El-Erian calls it a masterclass in resilience.
Right, a masterclass. It was a year defined by these huge concentrated bets on AI for sure, but also by a few things that happened in the economy that they completely defied what everyone was expecting.
Let's start with trade. I mean, the warnings were everywhere. U.S. tariffs were going to be a lose-lose-lose situation.
I've all heard it. A guaranteed stagflationary spiral, massive retaliation from China and others, and yet
It just didn't really happen like that.
it didn't. And that gets to the adaptability piece. China's export machine didn't just crumble. Instead, they showed this incredible dexterity.
It just rerouted everything.
They rerouted their trade flows. They aggressively targeted non-U.S. partners, especially, growing markets in Europe and Asia.
And it wasn't just a small adjustment. That rerouting was so effective that China hit a record-breaking trade surplus.
A number exceeding $1 trillion.
$1 trillion.
Mhm.
You have to stop and think about that number.
It's staggering. I mean, it's more than the GDP of most countries. It just proves that the tariff strategy, at least in its stated economic goals, was a total failure. The pressure didn't go away. It just got shifted somewhere else.
So while all that global trade drama was playing out back home, the U.S. consumer was basically holding up the world.
Absolutely. The U.S. economy crushed expectations. I mean, third quarter growth accelerated to what, 4.3%?
And what's fascinating is what was behind that. It was consumer resilience, even among low-income households. People just kept spending despite sky-high prices and growing debt.
The consumer was the engine, definitely. But we have to look at the fuel, The data shows that while the wealthy were benefiting from AI gains and asset prices going up, low-income households were keeping up their spending by running down the last of their pandemic savings, taking on more credit card debt.
So it wasn't sustainable.
Not at all. It was resilience built on consumption, not on broad, healthy wage growth.
So 2025 was this almost magical mix of AI euphoria, China rerouting its trade, and this debt-fueled American spending spree. It looked like everything was booming, but you said we need to look beneath the surface.
Precisely. That headline U.S. GDP number was great, but El-Erian sees these really unsettling structural trends emerging just underneath, and they signal trouble ahead.
What's the biggest red flag for you?
The first one has to be the decoupling of U.S. GDP growth from job creation.
Okay, explain that.
We're seeing real productivity gains, the economy is growing, but it's not creating the number of jobs you traditionally expect to see with that kind of growth. And this is happening even in the very early stages of AI and robotics adoption.
Okay, but let me push back on that a little. Isn't that sometimes just what happens after a shock? Companies get really lean, and when growth comes back, they squeeze more out of fewer people before they start hiring again. Are we sure it's AI and not just a weird cycle?
That's a fair point, and it's a good question. But I think what worries El-Erian is the speed and the nature of this decoupling. When you look at where the money is going, all this massive spending on robotics, enterprise software, things like that, it really suggests this is a structural shift, not just a cyclical one.
Meaning future growth is going to come from technology replacing people, not working alongside them.
More and more, yes. And that's a fundamentally different problem than we've faced in past cycles.
And that sounds like a perfect recipe for social tension, especially when you pair with that other trend he talks about.
Yeah.
The widening K-shaped divergence.
It's the other shoe dropping. The K-shape just means the wealthiest people are doing great. Their opportunities are on that upward arm of the K. But for most people, things are stagnating or even getting worse. They're on the downward arm.
So the gains of 2025 were just incredibly unequal.
Profoundly unequal. And when you have that decoupling fewer jobs from growth colliding with this divergence, this unequal distribution, something has to give.
And that's when affordability becomes a political flashpoint.
Exactly, almost overnight. You see the focus of politics shift. Like, look at the Trump administration's recent, really intense focus on housing and energy policies. That's a direct response to this social volatility. It's a public admission that the economic imbalance is causing real pain.
So if the U.S. domestic foundation is looking shaky, the global foundation is actually cracking. Elligan is really clear on this. The era of multilateralism, of coordinated global policy, it's in the rearview mirror.
It's over. We are in a fragmented world now, and it's dominated by geoeconomics.
And geoeconomics isn't just a buzzword.
Not at all. It just means that economic tools, things like tariffs, sanctions, tech restrictions, they are now the main weapons of foreign policy. The constant breakdown of international cooperation just confirms this isn't temporary. It's the new reality.
And we saw a pretty vivid example of this, right? The U.S. boycotting the G20 meeting in South Africa.
That wasn't just about some minor policy disagreement. That was a statement. It was a signal that unilateral national interest, especially seen through a security lens, now trumps global cooperation.
And this fragmentation circles right back to the trade issue and to China's rerouting. Europe is now the pressure cooker.
It really is. They haven't kept pace with U.S. growth or technology, and now they're struggling to absorb all these Chinese exports that are being redirected their way, especially things like EVs and solar panels.
It's not sustainable.
Not at all. And it creates huge political stress inside Europe.
So if this fragmented world is the new normal, how is power actually used? This is where he brings up the U.S. intervention in Venezuela as this kind of sudden, sharp lesson.
Right. With these complex demonstration effects, it shows how geopolitics can just completely override economic logic.
And the demonstration effect is meant to send a message.
A message, yes, but different audiences hear different things. On the one hand, it's meant to discourage smaller powers. He mentions Colombia, Iran, Cuba from challenging U.S. interests. It's reasserting the old hierarchy.
But there's a more dangerous effect, isn't there? The one aimed at the bigger powers.
That's the one. For countries like China and Russia, this doesn't signal American strength. It signals American willingness to just break the rules whenever it wants to.
It validates the idea of might makes right.
Exactly. The message that Beijing and Moscow get is crystal clear. If the U.S. is going to ignore international norms to secure its sphere of influence, then while we're encouraged to do the same thing to secure ours, it just accelerates the whole world breaking into rival blocks.
Okay, so in this volatile, fragmented world, let's go back to AI, the star of 2025. Why is that narrative going to lose its power in 2026?
Because the animal spirits, as he calls them, are finally going to be tamed. The indiscriminate financing of last year is running into very real fears of a bubble and, frankly, some disappointing results from early applications.
So investors are getting more selective.
They have to. They're moving past the hype, and they're demanding actual specific returns on their investment.
And this is where a critical gap emerges.
Mm.
Gap that he says isn't getting enough attention.
Right. It's not about who can build the best AI model. The West, the US and Europe, they're still leading there. The real gap is in working with AI.
The integration gap.
It's the integration gap, the speed and the success of actually adopting and integrating the technology into the real economy, logistics, manufacturing, general business. That is what will decide who wins the next phase of productivity growth.
So it's not the genius in the lab anymore. It's the efficiency on the factory floor.
That's where the real wealth gets created. And this forces a total recalibration for investors. The old playbook of just, riding a big structural wave throwing money at anything with AI in its name, that's over.
So what's the new playbook?
It has to be more tactical. It has to be bottom up. Investors need to be looking for what El-Irian calls market completion opportunities, meaning not the flashy models, but the boring but essential stuff. The infrastructure, the plumbing, the tools that actually let companies use this technology in the real world and make money from it.
And in this kind of volatile world, he also argues for a shift toward tangible assets over just speculative growth.
Absolutely. When the future is this messy and hard to predict, tangible things, real assets, they just feel like a much safer harbor. The time for relying on speculative miracles is it's running out.
And if investors have to recalibrate, You can only imagine the challenge for governments and central banks.
Oh, it's immense. They can't be saved by some private sector miracle anymore. The AI hype basically gave a lot of policymakers a free pass in 2025. That shield is gone now. Policy failures are about to be exposed.
And this is going to be especially tough for the U.S. Federal Reserve.
Very tough. Elarian's point is that the Fed has been way too rigid with its whole data-dependent approach. They're always looking at lagging indicators in a world that is changing structurally and changing fast.
And that rigidity, he says, has turned the Fed into a volatility amplifier. That's a pretty stark phrase.
It is. By waiting for perfect, backward-looking data like last month's inflation numbers, they always react too late to the shifts that are already happening,
So they end up having to make these bigger, more abrupt policy changes to catch up.
which causes these huge swings in the market. They're always chasing the data instead of anticipating the future. And if they don't reform how they operate, their political independence is genuinely at risk.
And this isn't just a U.S. problem.
Not at all. All the advanced economies need to pair these central bank changes with real growth strategies, high deficits and massive debt. That was easy to ignore when everyone thought AI-fueled growth would solve the problem.
But those deficits are a lot less forgivable now.
Especially when you look at the sluggish growth outside the U.S. I mean, Europe is the prime example. The kind of modernization they need, the stuff in the Draghi report, it's just moving at a snail's pace.
And that stagnation in a huge economic bloc like Europe just adds to global instability.
It's a drag on the entire system. It means they can't absorb these geopolitical pressures that are coming their way.
So at the end of the day, 2026 isn't going to be more of the same. It's a year for a decisive recalibration for investors, for policymakers. It's going to be messy, with geopolitics overriding the old economic theories.
It's the year we stop believing in the hype and we start dealing with the hard structural reality.
That definitely sounds like more of a navigation challenge than a boom. And look, if the future of productivity really is tied to this adoption gap, not just creating new models, that brings up a really serious question for all of us, wherever you're listening. Given this need for a tactical focus, for market completion, what essential infrastructure or tools are being overlooked in your local economy right now? What's the key that would unlock that adoption gap where you are?
Think locally,
Yeah.
because that's where the real productivity battle is going to be fought this year.
We'll catch you next time for the deep dive.